Well, welcome to today's webinar. We're excited to have you as you join us as we dive into the aspects of managing sales tax exposure and minimizing risk. If you have any questions at any point, please feel free to use the Q&A box located below. Additionally, for your convenience, we are recording this webinar. Our speakers today bring a wealth of knowledge and expertise in the field. First, we have Kaylin Kleinhans, who serves as our state and local tax practice leader. With over 14 years of extensive multi-state tax experience, Kaylin has made significant contributions across various industries. She specializes in state income tax compliance, local level gross receipt tax compliance, revenue sourcing analysis, multi-state nexus analysis, and alternative apportionment petitions. Her wealth of knowledge and experience make her an invaluable resource in navigating the landscape of state and local taxation. We also have with us Aubrey Stefanowicz, our sales and use tax manager. Aubrey brings our over 10 years of diverse sales and use tax experience, making her an integral part of our team. Aubrey's skills include sales and use tax compliance, audit defense, multi-state nexus and liability analysis, voluntary disclosure agreements, refund recovery, and taxability research. Notably, she holds the sales tax CMI designation for the Institute for Professionals in Taxation, a testament to her commitment to excellence in the field. Without further ado, let me pass this off to Aubrey, who will guide us through today's intricacies of today's topic.
Thank you for the introduction, Louie. So yeah, just to start off, I kind of want to go through some of the key takeaways that I hope you're able to get from this course. So, first of all, I want to definitely make you more aware of some of the recent changes and trends in the sales tax landscape overall. Also kind of give an idea of where things are going. So next, just to help you identify different forms of sales tax exposure, kind of just what that can look like for your company in particular. I hope we're better able to identify sales tax exposure and kind of go through some of the best practices for mitigating sales tax risk. And lastly, just kind of understand some of the resources and tools that are available to you to help you, identify sales tax exposure and get into compliance in any state you need to be. All right, so going through, starting off, just kind of what has changed, where we're at now. Many of you may be familiar with the South Dakota versus Wayfair Supreme Court decision in 2018. If you've listened to any sales tax folks, they've probably been talking about this. And it just continues to have a major impact on the world of sales tax. And just a recap of what happened here, this decision basically allowed states to begin enacting sales tax registration requirements on out-of-state sellers based solely on economic activity, basically the sales volume, sales dollar amount. And before Wayfair, the standard was basically your business must have physical location, employees, brick and mortar store. So that's no longer a requirement. And again, while this isn't new news, it just continues to have a huge impact. And some of our clients and people we see definitely still have some catching up to do to account for all of this. So yeah, that's kind of why we keep bringing it up. On that same note, at this point in time, we can say that any state that does impose a state sales and use tax now has an economic nexus requirement. So, there was a few holdout states, in Missouri being the last, their economic nexus standards became effective the start of 2023. So yeah, everyone's included now. A big trend as practitioners that we have seen is just a general uptick in sales and use tax audits across the board. Several states in particular, Washington, New York, Colorado, California, we've noticed more audits. We've noticed increasingly aggressive audits in the states. It just seems they're definitely very eager to pull in the additional revenue that they're able to capture. In my opinion, I think some of this may be due to just federal COVID support funds drying up at this point in time. So yeah, they're having to be a little more aggressive in capturing funds now. And just like the rest of us, technology's improved for the auditors. They have more resources, and there's been an uptick in hiring auditors, and just better tools for identifying what they would say is a productive audit, meaning an audit where they're able to assess tax. So just better data mining techniques. And some states, I'd say Texas in particular, they're just getting better at connecting the dots. Like if you're registered for franchise tax, don't be super surprised if maybe you get a sales tax notice at some point. Some states they're working to expand the sales tax base, expand what they can actually impose sales tax on. So yeah, some of the big things we've seen here, they're taxing services such as software as a service, platform as a service, any of these as a service type services, data processing services. And in addition to services, their states are also coming after digital products more, also digital video streaming services.
I think we have a question. So if we go on site for one day, does that establish nexus? If we ever go into a state for a trade show or a sales visit with a prospective customer, does that qualify for nexus? So really looking to understand, what does physical presence sometimes mean for SaaS companies as well as other industries?
Yeah, so my first disclaimer is, it does depend on the state, unfortunately. Having said that, like as part of our analysis, if you were only in a state one day, you had an employee there for one day, you don't have business activity otherwise, you don't have anticipated sales or other activities, even if it does technically generate nexus, it may not make financial sense for you to register, but generally it's going to be, the standard will likely be like 3 to 4 days or more, not just one day. So
Also, trade shows, there's exempt activities that if you go into a state for an exempt activity, it does not create nexus. Again, it depends on the state. So some states consider visiting for a trade show does create nexus. Other states say, no, that's exempt. So it really is on a by-state basis. And that's really where a by-state analysis can come into looking at that detail and applying the rules
yeah.
specifically.
Well, also, what are you doing at the trade show? Are you just an attendee, or do you have a marketing booth set up? Kind of what you're actually doing there can matter. So that answers your question. Yeah, so sorry, last thing I wanted to touch on here is just, we have seen some new tax types and applicable exemptions. Kind of the big one I wanted to point out here are the retail delivery fees. Colorado imposed this, I believe it was either last year or the year before, but now Minnesota has a retail delivery fee. And yeah, so these are basically imposed on the retail sale of tangible property that's delivered via motor vehicle. And this can be Amazon sales. They could also include like DoorDash food deliveries. Basically, they're imposing these to fund transportation infrastructure, and other green initiatives, electric charging stations, reducing air pollution. Yeah, on that same note, since the Colorado one has been around for a few years, a new aspect of that is they now have a small seller exemption for retailers who are making less than $500,000 in sales during the prior year. They're really just trying to go after the bigger companies here, because the cost of compliance can be large for a smaller company. And also now companies can actually just remit the fees, the retail delivery fees themselves without collecting it from the customer. Yeah, this is definitely a way to eliminate, kind of reduce the cost of compliance. having to adjust all of your ERP system and invoicing systems to collect a fee from every customer could be quite a task. So yeah, so those are just some of the things we've noticed and changes and trends. Now I kind of want to go to what we would say are basically the key components for reviewing the sales tax review process, kind of where to start and how to identify sales tax exposure, and then ending with kind of how to mitigate this, how to handle this and get in compliance going forward. So yeah, so some common red flags for that we see all the time doing this work, for companies that likely have some form of a sales tax responsibility. First one, just if your company is making sales of tangible property or services in more than one state, in multiple states. Also, if you have employees or property located in multiple states. Since the pandemic, the remote workers creating nexus has been a big issue, because sometimes you'll have workers in a state where you're not typically doing business, but all of a sudden you have workers there, and so that can change things and create a responsibility. If your company is just in the middle of experiencing any key business changes, a few examples: if you're launching a new product line, if there's some form of a vertical change, such as moving from selling at wholesale to retail, if you're going through any time of M&A activity or reorganization. And I like to point out that even if you're not typically in the business of selling tangible property, when you are selling a business and you are selling tangible assets, then a state may consider that like a sale of tangible property that is subject to tax. So definitely important to consider that. Startups and other companies just experiencing rapid growth year over year, it's a red flag. And just like I was saying, expanding your geographic footprint in general, doing business in more states. And also a big one is just if you have not had a formal nexus analysis completed, or if you have one that's a year or two out of date, that's a red flag. It's really good to keep those current, just to make sure you're in compliance and register where you need to be. Yeah, so the next thing I want to talk about is just identifying sales and use tax exposure. So once you kind of like looked at that first list, where we're looking at whether any of those red flags may apply to you, if any of those are applicable, we definitely feel that a further analysis is likely warranted on the sales tax front. So yeah, my second bullet point: nexus analysis and liability calculation. I guess I first want to kind of step back. I keep saying nexus, but just to explain what I mean by that, nexus is essentially, it's a connection with the state that jurisdiction considers substantial enough to where they can require a business to register and collect sales tax. So when I say you have nexus in a state, that means you need to you have a requirement according to the state to register, begin collecting and remitting tax. So going on, a nexus analysis, what is this? So yeah, this is basically completed to identify where and when a legal requirement to register for sales and use tax in a state exists. This is typically completed by a CPA firm, whoever you're using, where they'll basically review your business activities for a period of 3 to 4 years. These have become a lot more kind of common and also involved in the past, since Wayfair in 2018, since traditionally you were only looking at physical presence. It's pretty simple to look at, like, oh, well, you have an office in Nebraska, you need to register. So they're just more complicated now. And basically we'll be like, they would be summarizing your data by state and by year, just looking to see if you've exceeded any of the sales tax, the state thresholds in any form. While I said physical presence is less of it, but it's still a big part of the analysis. It's, these can get complex, especially when it comes to the economic side, since you would need to, each state kind of has a different standard on what their dollar amount threshold is. Most states have $100,000 a year or more than 100 or 200 transactions. The thing that does vary, though, is whether that threshold is it gross receipts, is it retail sales, is it taxable sales only? It's different in every state. So yeah, so next I want to talk about just when I say, because I'm going to say sales tax liability, sales tax exposure quite a bit. So what is that? So sales tax liability can basically exist when a business has a requirement to register in a state. You have nexus, and also you've been making taxable sales into the state during the period, but have not registered and filing returns. So these periods prior to where you've registered, where you had taxable sales and you have nexus, that's what those periods would have sales tax liability, sales tax exposure. And this can also, this can happen in other forms. For example, if you're making, you're registered in a state and you're making exempt sales for resale, but you don't have the proper resale certificate documentation on file, that could be sales tax liability as well. So yeah, just like an example of one of our clients I did want to bring up for kind of what this can look like when you do have exposure. So this client, they make online taxable sales. They've been making, this is New York we're talking about. They've been making sales into New York back to, I believe, 2015. And so they weren't registered. And then, the Wayfair decision happened in 2018. New York imposed economic nexus rules, and they still never registered, even though they had met the standard. So come 2023, they actually were flagged for a New York sales tax audit. So typically when you're audited, the look back period based on statute of limitations will be 3 or 4 years. But in this case, since they actually had not filed any returns, the auditor basically, they can look as far back as the taxpayer has nexus with the state. So they could look all the way back to 2018, which I believe was around 5 years, since they had not filed returns. So, their assessment was north of $500,000, and they also had penalties and interest for all the look back periods. So yeah, the further back you go, that interest accrues each year, it can really add up. So yeah, I just bring that up to mention, kind of explain what sales tax liability can look like and kind of the importance of it. So kind of still being on that second bullet point, liability calculation. This is generally performed as part of our nexus, or as part of a nexus analysis. And it's just basically, the purpose is to quantify sales tax exposure for each state. It'll typically involve looking at a taxpayer's revenue streams, and to determine which ones are subject to sales tax, and then basically calculating how much tax is due. This can also include estimated penalty and interest amounts. So another way to identify sales and use tax risk is just to have a taxability review completed. This can come in different forms, but it's basically, kind of a refresh of, for the products you're selling, which ones are subject to sales tax and which ones should not be. It's good. It's always important to kind of get these done regularly, because in the state and local tax world, the rules are changing constantly. So yeah, that is important. And I just kind of want to drive the point home at the end. Just a little work here does go a long way. It can be costly to kind of perform this analysis, get into compliance up front, but ultimately you can really save yourself money in the long run by avoiding these penalty and interest fees. So now that we've kind of talked about identifying sales tax exposure, this kind of next slide is just what to do about it. It exists. How approximately how much it is and how far back it goes. So really, at this point, it's going to be important to understand your company's level of risk tolerance. We often say that in the state and local tax world, sales and use tax, being 100% compliant is it's close to impossible. Things are changing constantly, and there's just so many jurisdictions, state level as well as some of the local jurisdictions in certain states. So it's really hard to monitor everything. The benefit, though, once you've kind of done this nexus analysis and you've quantified the exposure by jurisdiction, you can really kind of prepare your plan of attack, determine how to approach it. Which states do you want to go after first? Maybe you want to focus on a few at a time, knock those out, and keep going. So, yeah. So for the talking about the states where you actually I've decided, okay, I have a registration requirement. Maybe there's some liability here. What are the options? So I'm going to go through those now. Really, the first one, and if you just call the tax department and ask them, what should I do? I mean, they're going to tell you, well, you need to register for sales tax for the period when you first have Nexus. So, you can do that and get registered in that period, but you just need to know that there will be penalty and interest associated with the amounts owed during those periods. And there can be late filing as well as payment penalties. So another option is if you decide, maybe the liability is pretty low. It's not a huge amount, but you do want to get registered. Well, you can register for the current period and go forward from there. This is beneficial because it does basically start the statute of limitation clock, which generally prevents an auditor from looking back more than 3 or 4 years. But you have to be registered and filing returns for that to kick in. And yeah, it is worth noting, if you do have balances owed prior to the date of when you registered, it technically is liability that's sitting there that could come up. But I would say it's much less likely if you are registered, you're filing. Auditors are often kind of focused on just making sure that you're doing things right going forward and for the past several years, not back really far. So one other option that can be really beneficial if you kind of are in the right fact pattern for this is a voluntary disclosure agreement, a VDA. So this is basically a program that tax jurisdictions offer. It's basically an incentive for you to come forward and get registered when you do have back sales tax liability. It benefits the state, even if they want to get you registered and filing. So some of the benefits, really two main benefits. First of all, on any back liabilities, the state will generally waive any penalties related to that. One caveat, if you have actually collected tax from customers, they generally would not waive that penalty. But yeah, otherwise they will. Also, really the most important thing, especially if you have a liability going back more than 3 or 4 years, is they will limit the look back period. Once the state signs the agreement, both parties sign, the state is not allowed to look at any period prior to what they identify in the agreement. Again, usually 3 or 4 years. So, for example, if there's a company that has sales tax liability, back 10 years from now, and if they're ever audited, and the VDA, they had previously done a voluntary disclosure agreement with a 3-year look back period, the auditor cannot look back further than those 3 years. Whereas if there was no VDA, they could, and the client had not been filing, they can really look back all the way to those 10 years to look at everything and assess all of it. So it's definitely a major benefit. really the downside of that is it's not always the fastest process, and it'll typically, especially if you're having like a third party complete it, it'll cost a little bit more for the time input, but depending on the situation, it can really benefit you. Hmm. So yeah, on this slide, I'd kind of like to, I've kind of gone through just what the kind of the core sales tax review process looks like and determining if there is sales tax liability, how to manage it and mitigate it. So now I want to talk about kind of our team in particular and what we do and some of the unique aspects of how we approach these steps. So starting with nexus studies. So this process typically for us will start by us having an interview with our client, understanding business operations, and then we'll eventually get into the ERP data, start reviewing sales, and really up front, we're going to look at the different types of sales and perform a detailed taxability review. And when I say detailed, each one will have an explanation with the statutory citation for each. So once we've done that, then we'll basically take all the data and summarize it by state and by year and perform our analysis there. So this final product, it'll typically, it'll have the standard year data, nexus thresholds when they were hit, but we also put a very detailed analysis for each state on suggested next steps, kind of the next course of action for each state. And just, a lot of, if you do a nexus study at some places, it'll typically just say like, well, here's where you hit the nexus threshold, but they don't really give a recommendation. They just say you hit it and that's it. Where kind of when our recommendation, we're looking holistically at the whole picture, what makes sense for your business, kind of what your anticipated activity in the state is in the future. There's more factors to look at. So, and also when we are doing this, we're not necessarily just looking at states where you do need to register. We're also looking at states where you really don't, if you are registered and you don't need to be. This is really beneficial because, the cost of compliance, it's not cheap. So if there's a state where you don't need to file, like we definitely want to help you identify that state and, get deregistered so you don't have to file anymore. Another benefit of our analysis, we look at the exact month where registration requirement begins. Some of these are more just like looking at year by year, but if your registration requirement is in August, we're not going to tell you like you need to register in January. So that's 8 months right there where you really didn't even need to file and pay tax. So it could be savings in that on that front. And also we do one unique thing that we do. We kind of perform a detailed review of the threshold for each state. I kind of alluded to this earlier, but as far as what each state's definition of gross sales versus retail versus taxable, this is really important because maybe you do exceed a state's $100,000 threshold in the prior year. But what if the state only looks at taxable retail sales? So, we want to prevent any unnecessary registrations and saving in compliance costs. So as far as liability calculations, this is typically, for us, it's actually typically part of the nexus analysis. So again, we're looking at ERP data, performing the detailed taxable versus non-taxable review. Kind of, again, a benefit for us on this is we are calculating based on the exact month where tax collection begins, not the whole year, not approximate. We don't want you to have to owe anything more than exactly what you owe. So another part of our liability or part of the nexus analysis as a whole, we will perform some form of a VDA feasibility analysis to make sense, kind of give you a suggestion on whether it makes sense to just register for the current period, or is it better to is it actually worth completing a voluntary disclosure agreement? Maybe if you owe 5,000 in back taxes, we're going to say, no, it's probably not worth it for you to do the VDA. We don't want you to have to pay more to us and completing a VDA than actually just going ahead and registering. So yeah, we do complete voluntary disclosure agreements, sales tax registrations, other services. We also do provide audit representation. If you happen to be undergoing a sales tax audit, we can kind of help in a few different ways. We'll either usually offer like a full audit management services, or we could just assist you in the process as needed. And then we'll always review kind of the auditor's audit results and kind of consult with you on determining how to proceed from here. Should I accept? Should I protest? Yeah. We also can perform a refund review. Definitely if you're having high fixed asset purchases, dollar amounts, high AP activity of tangible products or software as a service, we can definitely help review and see if there are in fact any sales tax overpayments. If that's the case, we can also assist with refund recovery, recovering the overpayments, anything that's within the state's statutory period still open. And one difference in kind of how that would look on our team is we're really big on actually making sure you're correct, because if there's a refund, if you identified an overpayment, that's a problem. So we're going to help you figure out why there was an overpayment and help you correct that going forward. Well, we can perform due diligence reviews. Again, if there's any merger M&A activity going on, we can help on the buyer side, basically review a target company and identify any hidden sales tax exposure. On the sales side, if you're selling, we can also help just with gathering the documentation from the different states it's usually required. So yeah, we can help in a few different ways there. We can review exemption and resale certificates, make sure you're kind of up to date on those. We also perform ASC 450 contingency liability assistance, basically helping. So this is basically a requirement for audited financial statements where you need to basically capture any contingent liabilities. So and for us, we'd be looking at any contingent sales tax liabilities. If this isn't something you've considered before, I do highly recommend that you have a conversation with your current audit advisor, or if you don't, feel free to reach out to us and we can get you in contact with somebody who can discuss this. Yeah, so the last thing I really wanted to mention here is we do offer a really cool and free sales tax quick assessment tool. So basically what this is, it's essentially a scoring tool that you can use to assess your risk of sales tax exposure. It's really, we designed this to be very easy and quick. 8 questions, complete it in 5 minutes. So there's just a lot, this will basically give you a score saying, hey, look, your likelihood of having sales tax risk is pretty low. Or it can tell you, based on these activities, like you definitely recommend like further analysis, maybe reaching out to our team to kind of talk with you. So this is really cool because I know it can potentially uncover sales tax risk, but on the flip side, it can also uncover peace of mind for your business. Maybe you had some concerns, but based on this assessment, it's pretty low likelihood that I'm going to have tons of sales tax exposure. So yeah, it's just a good quick tool for you. And you can definitely, as you see on our screen, we have a QR code. You can definitely scan that And if you don't get the chance to do that right now, we can definitely send you the link after the presentation so you can take this.
Email will actually be going out with the link to all the attendees who signed up. So you guys should be getting an email with the link to take it as well. So
Yeah, exactly. But I mean, QR codes are fun. So so yeah, so now I'm gonna hand this off to Kaylin to talk a little bit about kind of some other SALT considerations, and also just kind of some more benefits of how our team performs our reviews in general. So
yeah, thank you, Aubrey. So, there's other SALT risks to consider, and we never want to do a webinar that doesn't, include some of the other considerations, especially with sales taxes relationship with business activity taxes. So business activity taxes generally include income, franchise, gross receipt, and other entity level taxes or filing requirements. They can be for the state, county, city, or other identified districts. So if you kind of think about sales tax on one side of the aisle, we have business activity taxes on the other. And what Wayfair really enabled is that economic nexus is now a valid constitutional method for states to say an out-of-state taxpayer has nexus. That doesn't just apply to sales tax, but it also started, because of Wayfair, being able to be applied to business activity taxes. So many states have seen Wayfair as an opportunity to increase their tax base, not just for sales tax, but for BAT taxes as well. And one thing that we're noticing is that by filing a BAT tax return, it can trigger the state to assume that there's a sales tax filing requirement or vice versa. And the reason for that is because sales tax has a lower economic nexus threshold than BAT taxes usually do. So sales tax economic nexus threshold, as Aubrey mentioned earlier, is about $100,000 of sales, of gross sales. For BAT purposes, that threshold is generally $500,000. Now, there are states where it ranges from as low as $100,000, meaning it kind of matches the sales tax economic nexus threshold rules, or it far exceeds it, with other states looking at $4 million. So there's a wide range of economic nexus when you consider BAT taxes, but generally, because most states have a threshold of about $500,000, it's assumed that if you're reaching $500,000 for a BAT, that you then subsequently have economic nexus for sales tax, since that threshold is $100,000. Another thing that comes into play is that when you file a BAT return, it often requires registering to do business with that state's Secretary of State, which can make it easier for a state to identify that you're a non-compliant taxpayer in other tax types, meaning sales tax. And so that can also put you a little bit more on the radar of the state. Also, sometimes when you register for payroll taxes, you are required to register with a state Secretary of State, and that again can put you on the radar both for sales tax and BAT taxes. So these interplays between these multi-state taxes can really create issues that are not just a sales tax issue, but a BAT issue or a payroll tax issue as well. One thing to consider is voluntary disclosure agreements can be very beneficial if you have long-term historical liability. They can, create a cutoff window of only looking back during the statute of limitations in the state. Also, waiver of penalties as well. And one of the key things about these agreements is that you have to make sure you qualify for them. And one of the key qualifications is that you're generally not registered in the state for the type of tax that you're applying for a VDA, or sometimes in certain states, registered with the Secretary of State. If you are, then you can potentially void the opportunity to do a VDA, not only for the type of tax that you have a liability for, but other taxes in the state as well. So, we want to make sure that when you're making a decision to register in a state, that the opportunity to do a VDA is not voided for sales tax or VAT tax purposes. Next slide. So what sets us apart? Well, it's really taking that holistic approach and making sure that when we're talking to you about sales tax, or we're talking to you about income tax or VAT taxes, that we're looking at them together, and that we're giving you that full picture to say, yes, you have VAT nexus, yes, you have sales tax nexus, but here's how aggressive the state is, here's the liability you're looking at for income tax purposes versus the liability for sales tax purposes, and really making sure that you can make a decision for both without negating the opportunity to do a VDA or to inadvertently trigger the state to send you, an income tax nexus questionnaire because you registered for sales tax purposes. As Aubrey mentioned earlier in our webinar about Texas, Texas is one of the best states to connect the dots. If you register for sales tax, they are going to send you a franchise tax questionnaire. If you register for franchise tax purposes, they're generally going to ask you about sales tax. So we are seeing more states be better about connecting these dots. And that's really where we can help make sure that if we indicate on our sales tax nexus study that you have sales tax nexus in Texas, which is always fun to say, we would also then subsequently recommend that you register in Texas for franchise tax purposes so that you're taking care of it all at once. It's one registration, and we're being proactive instead of reactive with the state. This also enables you to coordinate and combine VDAs for sales tax and VAT purposes. Some states allow that, where you can have a VDA for sales tax and income tax purposes together. Other states consider them separate. So again, of course, in our world, it always depends on the state. It always depends on the jurisdiction. But where we can, we like to coordinate and combine. Again, this creates some tax savings for you so that it's one VDA instead of two. So the cost of compliance is a little bit lower, as well as you're being, again, proactive with the state instead of reactive. One thing to also consider is sales sourcing review or analysis. Quite often this is seen as a business activity side of thing or income taxes, but really what we're seeing is more and more SaaS or electronically delivered services. There's opportunity to say, well, actually my users are in 5 different states, and of those 5 states, maybe 4 don't tax SaaS. So really I should only have sales tax that I'm paying on one state that taxes SaaS, or sales tax that I'm collecting and remitting only for that one state because your customer only has users in one taxable state versus maybe their bill to address is in a taxable state and you would be subjecting the full invoice to sales tax. So we're seeing more and more opportunity to kind of split the gross receipts to a location other than billing address. Again, it depends on the state, but as we get more and more into electronically providing services and technology changes, the states have started adopting some of these rules. So it could be that you are overpaying sales tax, especially with electronically delivered services or software, or that you're over collecting sales tax in that situation. Also, gross receipts tax preparation or review. Something really key here is that even though gross receipts taxes are not applied in the same way as sales taxes or income taxes, the responsibility to manage these returns quite often falls to the sales tax team, or they go unnoticed and unaddressed because they don't perfectly fit anywhere. They're not sales tax, they're not income tax, and yet they are entity level taxes that can be significant, even if for a net income purposes, for federal net income purposes, you're in a net loss, a gross receipts tax remains having liability because it doesn't allow deductions. So you can be a loss corporation creating net operating losses for income tax purposes and still have a significant entity level tax in a state that has a gross receipts tax or jurisdiction that has a gross receipts tax. So for our team, we really make sure that when we do a nexus study for BAT purposes and for sales tax purposes, again, looking at them together, that the gross receipts taxes are also included in there. So that's why I don't just say an income tax nexus study, because we look at more than just income taxes. We look at the business activity taxes that the entity is subject to, and we look at specific key localities as well. You know, we're based in California, and unfortunately, California has a lot of local level gross receipts taxes, such as San Francisco, LA, San Mateo, Oakland, Berkeley. All of these jurisdictions have their own gross receipts tax, not discounting that there's also states with their own level of gross receipts tax as well. So again, we really just like to take that holistic approach, really make sure you have the whole picture, specific to your facts and circumstances of the company in today's world with today's rules and laws and whatnot, and really help guide you of how to be best compliant within reason, within business sense, right? It's not just the letter of the law. You know, that's, as Aubrey alluded to, it's almost impossible to be 100% compliant anymore. So we help guide you in making those decisions where the focus should be. Kind of, you know, quite often, if you do have a lot of states where it's deemed that you have nexus and you haven't been filing, setting up a plan for kind of turning them on over a period of time, because turning on, you know, all 20 states that you might have nexus in for sales tax purposes can create a lot of work all at once that can be overwhelming and hard to manage. So maybe it makes more sense to take it in stages and turn on 5 states, register, get compliant, then, you know, 3 months later, turn on another 5 states, right? And so again, it's looking at your specific business needs, what makes sense for you, and making sure that we can help you to the best of our ability. I think that's it.